Chapter 9. Sales and Purchases Source Documents, to Sales Daybooks, Sales Ledger, and the Trade Receivables Control Account. Key points from this chapter. There are stages from negotiating a transaction through the account system to eventually appearing in the trial balance. So we'll have to go and see those stages and see how it goes. Many individuals are involved in this process from ordering to receiving goods or services and payments. The work of these individuals needs to be coordinated and controlled. And we control it using codes, documents, books, ledgers. That's how we're going to control them in our system. A manual system is limited by people needing to aggregate and transfer lots of numbers and physically write down those figures into our ledgers. So as a result, that's why we have all these different books there. They only exist typically in a manual system. In an electronic system, you don't tend to see the day books. Source documents and books of prime entry will be determined by the company. There's no set layouts in there, so we'll see why they're determined by the company in a particular way. So, any source documents or notes will be provided to you in order to create, in the exam, let's say create sales invoices or sale purchase orders, purchase invoices, sale returns, a whole series of these source documents. So that information will be given you in the exam to produce. You don't have to produce those yourself, but you will have to fill in the boxes, really. Alternatively, you might need to take one source document and reconcile it to another. In a manual system, the sales and purchase invoices and credit notes are then collated into books of prime entry day books, which are going to aggregate a lot of information to smaller numbers. You might be expected to do that in an exam and put those then into supplementary ledgers. In electronic systems, you don't tend to see the day books in there, so you won't see that typically in real life because the computer's sort of adding up for you and posting it into the right ledgers. Source documents within a company will have been built up by the organization's professional accountants or advisors over time. Those professional advisors will hold the view of sort of professional skepticism, that what can go wrong will go wrong without adequate control. So you can see lots of different codes and controls within these source documents and various books of prime entry to try and sort of prevent errors and have controls. And really, there are also as well that employees will commit fraud. They'll commit fraud in moments of weakness or what have you. Included within the source documents will be extensive checks and codes to ensure accuracy and probity, honesty, really. These cross-checks ensure employees do their job properly, procedures and policies are followed. They'll also segment the work between different individuals to make it difficult for one person to commit a fraud without another spotting it. So whilst in real life you might find this level of checking intimidating when discussing the position with a professional accountant, it's unwise to retort to what you're saying, you're not doing my job properly. The checks are simply a safety net to create a strong control environment that prevents fraud or misconceptions. Because source documents are built up from the professional accountant's view of the threats facing the accounting system, there's no standard layout for source documents. They're created and adjusted over time to meet the needs of the business with a balance of efficiency versus necessary control. Being aggressive or evasive should be avoided when questioning a procedure in real life. At least if you're in an accounting department and you're sort of seeing something, or somebody wanted to introduce a new control, being aggressive or evasive should be avoided when questioning the procedure. This simply increases the risk profile for the purpose of the professional accountant reviewing any system. So they just add in even more controls if you do that. It's useful to understand the thinking behind the controls so you may implement similar control measures in the future. Right. So quotations. For a contract to exist, there needs to be an offer by one party, acceptance of that offer, and consideration of price to be paid. The financial transaction may start with a conversation or looking up a website for a price list, but often it starts with a formal quotation. There's no set layout for any of the source documents, but the information is designed to provide companies with the ability to track and post financial transactions. There's no set layout for this, but we're trying to sort of say exactly what we agreed here. So we have a quotation here, and we've got a little bit of introduction. Please find this quote. It usually has a how long it's sort of due for, in terms of the prices. We'll have some addresses and some dates in here. Might have customer codes in there, but if that's possible. And then we're going to have some items, some product codes typically as well to make sure that that's clearly what the item is. Some amounts without VAT. Some quantities and some totals. Now it might be a question that they may just sort of give you the excluding VAT figures here, and then you have to calculate VAT if you want to on a purchase order or what have you. It might set out some kind of discounts. We'll go through discounts in a minute, and it might set out VAT, and it might not. Those quite often, especially sort of in the, let's say, construction firms, will just try and set out the position excluding VAT, and in the hope that you might agree to pay over this amount and forget about the VAT, really. Which you then have to pay later on as a bit of an unhealthy surprise. So you might also well have credit terms. on there as well, and we'll go through credit terms as well later on in this chapter. So there's our quotation. That's sort of starting it. Although in an exam you might be expected to either fill in the quotation or alternatively take that quotation and create a purchase order. We've sort of seen discounts here being introduced. So let's sort of take discounts at this point in here. So we've got three types of discounts that you will see, and you will be expected to calculate these discounts. Two of them, the trade discount, is because, and the bulk discount, we'll go through those first, because the trade discount is because of who the buyer is. So the buyer is a trade buyer rather than a member of the public. So they're expecting a reduction in price. Let's say a plumber at a builder's merchant might expect a lower price there. So they're offered because of who the customer is, or the amount, who the customer is, and the bulk discount is the amount because of the amount purchased. These amounts are not included in the final amount to be paid on the invoice, so they're deducted, that will be then entered into the sales daybook. Instead, the amounts after these discounts are included in the sales daybook and in the sales daybook. So if we go here, back to this quotation here, we'll see how we got the amounts that we got here, but then we've deducted off the bulk and trade discounts to get to the net amount here. Now, if this was a sales invoice, the bulk and trade discounts will be coming off to get to the net amount there, and that's what we'll be going to. We'll see later in the sales daybook and the sales control account. So we'll have those ones there, and the reason why is because we want to calculate the VAT after the deduction of those discounts. Okay, so those trade and bulk discounts are going to be deducted from the net amount before calculating VAT. Now here's a little trick within the exams, because the prompt payment discount is a payment for early payment. So it's not known at the time of the sales invoice, so it's not deducted at that time from the net amount. So it's not deducted from the invoice. So quite often you'll see a sort of description of, let's say, might have sort of put a line in there of discounts, just discounts without any description there. Offer up a prompt payment discount in the notes of the question, and then see if it'll trick you by trying to get you to actually deduct the prompt payment discount from the net amount in the sales invoice. You don't do that. So early payment discounts are only entered into the account when the payment is received. As such, they would not be known if it was deductible when the invoice and the sales daybook were being prepared. The total amounts on the invoice of the sales daybook are therefore before any early payment discount. Where a company offers credit terms, so when we see those credit terms there, they will certainly typically be a certain number of days, let's say 30 days. So you might have a question which is saying, when should these customers pay? So a certain number of days, let's say 30 days. It might be within the month, so by the end of the month. Or it might be net monthly, and that's by the end of the following month. So let's say if you had a sales invoice on the 10th of the month in there, so let's say 10th of July, and it said net monthly, the payment would be then the 31st of August, so it would be the end of the following month. Suppliers may attempt to breach credit terms, in which case the seller may refuse to sell any further amounts or require payment up front. But where there's a power imbalance, such as between, let's say, farmers and supermarkets, there are provisions within the financial statements requiring companies to state how quickly they pay their suppliers. So you may see a question, certainly at level 3, where will some suppliers enter into unfair practices by trying to not pay their suppliers on time. Kind of things. Typically supermarkets will be mentioned from that point of view. Not at level 2 though. You're just going to be at level 2. You're going to be just calculating the discount. So we've got our quotation, and we've got our quotation, and we've done our payment terms. We've agreed what we're going to do, and now so the seller's sort of said, negotiated with the buyer what's going to happen really here. And now we're going to have a formal purchase order. So the buyer will place an order with the supplier, and typically they'll provide a purchase order to allow the order to be placed on their accounting system and confirm that this is an authorized purchase. Many finance departments will not process an order without a purchase order, or buying finance departments will not process a later sales invoice without a purchase order. So actually what you'll tend to see is either the seller or the buyer without a proper purchase order. So let's see, we've got purchase order reference in this one here. Both finance departments will not really like that, either the seller or the buyer, if there's a sale being suggested in here without a purchase order and without a purchase order number. And the reason is that these buying finance department will often later on complain that this isn't an authorized purchase, or they'll slow up the payment, or they'll sort of question the order or what have you. And so that'll be an issue. And in terms of the buying department and the internal managers, they'll want to control purchases as well that are made by a company, and so they won't really want buyers or managers going out just buying willy-nilly without going through the finance department first and getting a purchase order. So the purchase order reference here is a number given by the buyer, put on its purchase order, and that's going to be the number that's going to be used to track the actual whether this order is authorized or not, up to the point of the sales invoice, and then the sales invoice number is going to take over. So an example of a purchase order is given here. So we've got our address and our dates and what have you. We've got our purchase order reference sitting here, it's pretty important. Then we're going to have our types of purchase. We often have product codes sitting there to make sure that it's the right thing, as we've sort of seen in our quotation. Prices before VAT, total numbers, total amounts. Again, we're going to have this little trick, aren't we? In our little, we have a bulk and trade discounts here, but we haven't got a prompt. We wouldn't have a prompt payment discount at this point in here. VAT. Remember, track whatever the VAT rate is, and the order amount could be as well. You might sometimes go item and quantity and VAT in a column here with the total amount, especially if they decided to try and give you VAT at different rates for different products as well. So the buyer's placed an order, and now the supplier is going to deliver the order. So they're going to, in the way in which they're going to do that is they're going to have they hand over the goods, but they're going to have a delivery note that goes alongside it. The seller will provide a delivery note with the goods shipped. If they don't, then there will inevitably be a dispute over what was actually sent, if anything. This note can be a 2 or 3 part document. So it means two pieces of paper, with one part being carbon paper below, and any writing on top of the paper transfers into the bottom. One part for the buyer and one part for the seller. 3 part if we're going to use a courier as well who want to also track it. In a more modern system, it's really a 1 part document really for the buyer, and we sort of hand it over, and then some kind of form of electronic signature or tracking device for the seller and courier. The buyer will sign the note to say the amounts have been received. Although notes now typically tend to become more electronic, in the same way as, let's say, you sign for an Amazon parcel. The delivery note is a proof of delivery, and it is especially important in companies, as they are typically large organisations, and the initial handover of goods, let's say at a reception, will rarely be to the intended recipient. Without proof of delivery, many sales will be questioned by the buyer as not delivered when they were actually just lost in the organisation. So that's the reason why the sellers want to have these delivery notes, is that it's going to get lost somewhere in the company. A lot of products get lost in the company, but you want to have this sort of delivery note and say, no, actually, to be fair, you've signed it as received. So there'll be a signature usually as received in here. Often has some position. Might be some form, although this is the date on the delivery note, might be an additional date down here about when they signed it. That kind of thing. We've handed over this stuff in here. You've accepted it. Now, as I said, the person who initially signs for the goods is probably not going to be the person who checked it, especially if we've got raw materials coming in and we're going to put it in a warehouse or whatever. So the company may operate, the buying company may operate with goods inwards and received notes. It might be called the goods inwards, because some of the goods received notes, sometimes goods in note, as all purchases may not come with delivery notes, and they might not use the same standardized coding system that we might use in our own inventory control system. So the goods inwards notes also allows for later checking the quality when the packages are actually opened, so we can sort of check and say whether this stuff was actually agreed. Reception has sort of said, well, yeah, there was 10 of these items or whatever that came in, but actually were they any good? So this is an example of a goods in note here, and we've tracked it back to that purchase order. So we've sort of seen this purchase order going through and keeping it the same there. Here's our products with our product, but you see here we've now got a different product code. This is what we're calling this product code when we're putting it into our warehouse in here. So we've said that there, but we might put the customers or the seller's product code as well. And that quantity that they're going to have stated as delivered, but now we're going to start tracking it. How much did we actually order? So in the exam you might actually get different amounts between the goods inwards note and the delivery note. They might have provided us 100, they may say they've provided us 100 pens, but they've actually provided us 9 boxes of 11 or something like that. So we'll sort of see. You tend to see that one. So we just have to sort of check between the two notes. Well, and then we might have to say, well, actually, this is the actual amount that was delivered. The one's missing in here, and then we might have some kind of idea about, well, some of it was faulty as well. Signed as checked might also have additional ones like signed as where the person who's in the warehouse, where they're going to put it, and Goods received notes, they tend to be used where there's a stock control in a warehouse, something like that. And the reason is to highlight who checked the item. So did they check it properly when, for example, at a later date, fault breaks down and smashes our machine on this workshop floor, or who, and also as well who might put it in the warehouse, and did they steal it before putting it in the warehouse? So we might have signed as checked. We might have also signed as received or something like that in the warehouse. And we may choose to provide a goods return note as well for the faulty products. Although today's deliveries tend to come with pre-packed sort of tracked returns, sort of the barcodes that you tend to put on things now, so those goods return notes are tending to go out of fashion. As we've sort of seen, it really very much depends upon the company in terms of how they might decide to set out the goods inwards notes. But the important thing for you at this point is know what a goods inwards note is. It's the buyer who's doing this, and they're checking it usually to the delivery notes and to the orders. They're reconciling them back and seeing whether they're agreed, and that's what you'll be doing in the exam. Is you'll be reconciling these notes between each other and highlighting the differences. Let's go into a sales invoice. So we've had this purchase going backwards and forwards now, and we've actually received some goods in here, and so we're now at the point where the goods are agreed as being ordered and received. The seller is going to raise a sales invoice, and it's going to form two functions. It's going to set out the information on the goods and services sold for the company to then pay. If the company does not know who to pay and why, it will not pay. So if without a sales invoice and actually knowing what it's going to pay and why it's going to pay it, it's just not going to pay. So we'll never actually get our money in as a buyer. Quite often in real life as well, the ability for a finance department to invoice promptly and accurately is very important. Quite often companies can struggle, not because they're not good at their work and profitable, but actually because the finance department doesn't get around to invoicing properly, or alternately bits are missing. The easiest way to make losses is to not actually get paid for what you do. The second thing that it does is it provides a VAT document allowing the purchaser to reclaim any sales tax, such as a VAT that's been paid, and if they're able to reclaim that tax. So you see here, this sales invoice now has a VAT number sitting on it. This sort of VAT number is the VAT number of the seller here. So it's sort of saying that the seller is going to pay that VAT the VAT. So the seller is going to pay over this VAT over here to HM Revenue Custom, but the buyer might be able to recover that VAT back. In order to do that, he's going to have a VAT invoice here with that VAT number. Bulk and trade discounts are before any amounts payable, before the total amount payable and then the VAT calculation. So you see here, we've got this amount that we've been, the amount excluding VAT in here. We've then taken off our bulk and trade discounts, and then we have the amount after discount before we work out the VAT figure. The prompt payment discount, if taken advantage of, will be determined later. In this invoice, because it's clear that there's a prompt payment discount, it's not required to raise a later credit note for this amount, although you must be careful that in some questions it will not consider this. Sometimes you'll sort of see it in the exam questions that it won't really consider whether this has been included or not in the invoice and ask for a credit note to be raised. If it's in one of the multiple choice questions, I might ask that. Typically, often you tend to sort of see that really you don't need to raise the credit note later on if this thing's on it, but that might not be the question. That might be where the examiner sort of sets it out in the exam. The sales invoice includes the VAT number of the company, allows HMRC to track where the VAT has been paid and who they should receive it from. The sales invoice for the seller is the purchase invoice for the buyer. So this looks like a sales invoice here. So you see it's called sales invoice and it's from here. So in this instance for Norton Computers, it's the sales invoice. For Burke Technical Installation, it's actually the purchase invoice. So Burke Technical Installation will probably scribble on it well, it's got the order number there. It will probably write its own number up here somewhere and write it on it and then file it sequentially. So they're not too different. So the purchase invoice and the sales number are not two different documents. They're simply the same document called by a different name based on whether you're the buyer or the seller. So you're now in this position. We've got this sales invoice to enter the sales invoice or purchase invoice into the accounting system. So we're now going to look at some books of prime entry. So imagine a finance department where there's just one manual book containing the general ledger that includes the sales account and the trade receivables control account, sometimes called the sales control account. Around this book gathers the person who creates the bills for customers, sales invoices, the person who gets the bank statement, and posts the money received from customers, the person who chases the customers who have not yet paid their bill, the debtors clerk, and at the same time there's a purchase clerk waiting to enter purchase invoice, and HR wants to enter the payroll to be paid into the wages control account. All of them want to make entries and read whatever's owed in this general ledger. Only one person can read the book at a time, or make entries at a time, and whilst everyone else has to sort of wait their turn. As you can sort of see, chaos is going to soon ensue, as well as a great deal of sighing as each other over the time being wasted. When a person finally got to read an account for sales, they would soon be confronted with an entire year's sales to sift through in order to find the one invoice they were after, in comparison to and comparisons of amounts of sales made each day would be impossible. When it came to determine how much a customer owed, it would be impossible to work out either, because their invoice would be jumbled in a mass of other entries. To avoid this wasted time in a manual system, the books are separated into books of prime entry. These are lists prepared by the staff member and a total to be entered into periodically, typically daily, and that's why they're called day books, really. So typically daily, we're going to have a list of these sort of sales invoices in the sales day book, and then they're going to these amounts are going to be entered then into ledgers. And as we've seen already, these are T accounts that form the trial balance in the general ledger. So those are two-sided journals going into the general ledger, and then there'll be breakdowns of the T account, the trade receivables control account in the trial balance. So break down that T account, those control accounts in this trial balance. So let's say the sales ledger, which is the breakdown of the trade receivables control account. The books of prime entry are posted into these ledgers once those entries are totaled. So we're going to total these amounts here. So the reason then for these different books and terms is the need for several people to work at once in a manual system. It doesn't exist in an electronic system where everyone works on the same database at once. Sales are entered instantaneously and reports are run from the data rather than from maintaining separate ledgers. So daybooks don't exist in an electronic system in the same format. So you can have an entry scheme just to put in this invoice. The invoice is created and it's posted immediately to the trade receivables control account and immediately to their account on the trade and the sales ledger. But in a manual system, you can't do that because you've got all these people all sitting around the one book in the manual system otherwise. So it's also important to understand the manual system is going to help the professional account. So, why then do we have this sort of teaching of the manual system in an exam? If we know that it doesn't really exist anymore, this sales day book doesn't exist anymore, why do we actually still teach it in an exam? Well, the reason why is because it's important for the professional accountant to understand how to organise the finance department, implement controls and fix errors when they occur. So a knowledge of day books allows consideration, for example, of segregation of duties. So I'm not going to go, well, actually I'm going to split up who's going to do my sales. So this sort of thing gets us used to the idea that there's going to be one person doing the sales day book. There's going to be another person doing the cash book, and another book of prime entry. There's going to be somebody else, a different person, chasing the ledger. Splitting these up to create segregation of duties, where an accountant's departments function separate among their staff, and that's going to prevent fraud and extensive collusion. Well, it's going to prevent fraud without extensive collusion. So that's the point really of why we're doing this sort of sales day book kind of approach. So here's our sales day book here, and it's completed from the sales invoice made to customers on credit. So it's on credit here. Sales made for cash are included in the cash book, but may also have invoices for VAT for purposes to allow the purchaser to recover their input VAT and so simply get a receipt. So this is purely the sales day book, purely for credit sales. Cash book for cash sales. The sales day book sets up the money expected and where it will go. Not all of the sale will eventually go to shareholders. If the company sells an item for £120, there will be there may be sales tax, VAT paid to the government at £20. The company may decide it pays over parts of the sales, let's say, to charity. And that'll be another column in the sales day book. So this total amount that we're going to sell, or that we charge the customer, some of it's going to go to the shareholder in the end, but some of it's going to HMRC, as we sort of set out in our VAT chapter. So we expected to put in a number of invoices, let's say, and put some invoices into the sales day book, complete the sales day book. So we've got our date here, customer names, invoice numbers. Now here I've got the dates. Sometimes you might not have the date in there because it's just the day, the date might be up here somewhere. Total amount owed, VAT and net. And you'll be expected to drop some numbers in here. Or alternatively, you might be given a sales day book, or actually drop some numbers in there, or drop an invoice in there, complete the sales day book, and then work out a journal that's going to be posted to, whatever. So This total amount here is going to be posted to the Trade Receivables or Sales Ledger Control Account. Same name, Trade Receivables Control Account or Sales Ledger Control Account. Trade Debtors Control Account, all there, the same name for the same thing. That's in the General Ledger Control Account. This amount here is going to go to the VAT Control Account. So it's a sale, so that amount's going to be due. It's going to be debit the Trade Receivables Control Account. This one is going to be credit HMRC because it's a money out item, money going out to HMRC that we owe them. Money in item, debit, Trade Receivables Control Account, credit, VAT on sales. And then credit the sales account, which is the amount that's going to eventually go to shareholders. That amount. So you won't be expected to produce that journal in Excel. So this sales data book has been posted weekly here. The journals for posting in the General Ledger is debit the Trade Receivables Control Account and the T account in the General Ledger 8688. And we're going to have credit the VAT Control Account, the T account in General Ledger showing the amount owed to the VAT to the government 1448, and credit sales, which is the amount that's owed to shareholders eventually of 7240. There's also going to be as well a journal to the customer's account in the sales ledger. So all of these, you see here, we've got these customer names. Now you might also see in the sales daybook, let's say customer account codes. In here I've just got off the names in here, but you might also have a little column which will have like customer account codes in there as well. So there might be a journal to post the customer account journal in the General Ledger. And it might, now this would be a one-sided journal because all this sales ledger is a breakdown of the sales ledger control account. So if I've got debits, let's say of £100,000 in the sales ledger control account, of which 8,688 is coming from here, the sales ledger is just going to show how that's broken down by all our suppliers. So it's going to be a whole series of T accounts all adding up to the amount that's in the sales ledger control account. If we just looked at it from the sales ledger control account with £100,000, we haven't got a clue who's actually owing us that money. So we post these amounts as a debit, a one-sided journal, to our sales ledger. So because it's posted just the supplementary ledger, the sales ledger, that's only the breakdown of what is that debit in the sales ledger control account. There's only a one-sided journal. Okay. So now we've got so this is the Trade Receivables Control Account, also known as the Sales Ledger Control Account, or the Trade Debtors Control Account, or the Customer Accounts Control Account. And here's our T account in here in the General Ledger. So let's say we've got a brought forward figure in here. We've got an amount coming in, let's say from the sales daybook. That's a daily amount there. Let's say the customers have paid over something from the cash book here. We might have an early payment discount that we've that's been taken advantage of. So when these customers paid here into the bank account, they might have also as well had an early payment discount. And then we've got a carried forward figure down there. So that's a sales ledger control account in the General Ledger. So just remember that there are many terms for the same thing in accountancy depending upon the year in which the account is taught. So the Trade Receivables Control Account in one area is one area where there's many names. So Sales Ledger Control Account, Trade Debtors, Trade Debtors, Customer Accounts Control Account. So the Trade Receivables Control Account is the total of all debtors from customers at a point in time. It's the total of all the sales on credit, less any amounts paid by customers, less any early payment discounts to customers. It's like a T account, like all the other T accounts in the General Ledger. The reason for the different names is simply that sometimes given over just the names given over time with different names. So accounts of my generation were used to Trade Debtors, which has changed to Trade Receivables today when UK GAAP changed to International Financial Reporting Standards. So we've got this example here. Then we've got an example for the sales ledger here. So here's where our particular sales ledger has broken down. So we've got in our sales ledger control account, this will be made up of a whole of our series of customers. So this amount here, right, let's say this figure here, could be a whole series of different customers. We need to know, well, who is it who owes us money? So let's have an example of a sales ledger. So a sales ledger would be all of our customer accounts broken down by individual accounts. So in here, this is our customer here, and we started with this amount in here, and they've had some invoices coming in here. So one-sided entries from the Jets and the sales daybook. So the sales daybook has come back and posted those two invoices into here. they've gone and made a payment over here. They've taken advantage of an early payment discount there, and then there's their control account. So the sales ledger, different to the general ledger, not part of the general ledger, just showing a breakdown of an account in the general ledger. And you'll see that the same with the purchase ledger versus the purchase ledger control account, or the trade payables control account, whatever you want to call it. And these supplementary ledgers, like a fixed asset one to show how the fixed assets amount breaks down, those kind of things. They just take a general ledger account and break it down into smaller items. So you can see it saves you having to have 500 different accounts for all in the general ledger for our trade debtors. So it might be a question though that you've got a sales ledger control account, and you've also as well got a sales ledger. So it might be a question that you're given a question in the exam to go and reconcile the two of them together. If you're going to do that, what you're going to have then is a sort of you might be given a total amount of the sales ledger, a total amount of the trade receivables control account, and then you're going to sort of see, right, okay, well, what's the difference? And then you're going to give some scenarios about what could possibly be the difference. So in this thing, let's just go through how we answer this question. So step one, you're going to total both the sales ledger control account and the sales ledger to determine what the difference is. You might sometimes as well be getting tricked by the examiner. They might put a credit amount in the sales ledger for an account in the sales ledger to show that, let's say, a customer paid in advance, something like that. Anyway, total sales ledger control account, total sales ledger, work out what the difference is. Then you're going to be given a scenario, or you're going to give a series of scenarios, and you're going to pick which one could be responsible for the difference. So using the scenario offered, what you're going to do is you're going to create the journals for each of those scenarios. So you're going to create the journals what might happen. So for example, a £400 invoice has been posted to the general ledger control account twice. Let's say that one there. So you're going to work out what's actually happened in here. You're then going to reverse that journal that would have been posted from that particular scenario. So in this instance, I'm going to reverse out that journal. So I'm going to go and credit sales ledger control account 400, credit sales ledger 800. And then instead of, if those sales ledger control account and the sales ledger now equal each other, the trade receivables control account and the sales ledger now equal each other, and that scenario, that's the scenario out of A, B, C, or D that created the error. If it's not equal, then it wasn't that scenario that created the error. So that's one type of question you might see in terms of the reconcile the sales ledger to the trade receivables control accounts. And generate whatever the journal is created under that A, B, C, D scenario, reverse it, see if it now equals, see if they equal each other. Right, so remittance advice. Customers might provide remittance advices of the payments they're making and the balance that they think that they now owe the customer. So might owe the supplier. So sometimes customers might go and say, well, actually, I paid this, and now I think I owe you that. Right? So the reason why they do that is so that they don't get chased anymore for the money, or alternatively, they're sort of reminding you that I've taken advantage of a sort of a prompt payment discount. These remittance advices can be checked to the sales ledger to see if there's any difference in understanding. Areas such as early payment discounts, missing invoices, or transposition errors on invoices are they're good areas for exam questions. In real life, such remittance advices form source documents to confirm the accuracy of account information. Orders may also sample check the value of debtors through confirmations with customers of amounts owed, or review future payments. If the customers paid the amount, and then fine, it's probably going to be real. If they haven't paid it, then probably won't be real. So this is an example of remittance advice here. We've got our supplier, and we've got our the supplier code that we think that the buyer has called this company. And they're going to sort of say, well, look, I've paid you for this in here. I've had that credit note knocked off as well. There's what I'm going to pay you, and there's what I think the balance is that I owe you. So they might sort of say that in here. You'll then have your sales ledger account, so the account for this particular supplier, or sorry, for this particular customer. So let's say if I went to the sales ledger, I'd look for Burke Technical Installation. I'll pull out their account, which forms then part of the overall trade receivables control account, and I'll compare it to then say, well, actually, no, hang on a second here, we didn't agree. Whatever it was that. In there, or there's another invoice that you actually haven't paid for and missing in here. So you'll tend to see that, and you're going to have to sort of reconcile the two of them together. Now, a company might choose to remind customers of amounts due through a supplier statement. So that's not an invoice. We've already done an invoice there, so we're not sort of starting to put in all VAT calculations and VAT numbers and whatever on there. It's only going to show the amounts totals due, not VAT or discount adjustments. It'll reference the invoices or credit notes. And effectively looking quite similar to a T account. Right. So here I've gone money in, money out item. They're to produce the amounts that is due in there. So this is an example of a supplier statement. Now the reason for a supplier statement is to give the customer a bit of a reminder. Listen, you owe us this. Can you pay, please? And so that's there though. It might also as well prevent any kind of misunderstandings where somebody's thinking there was a credit note and there wasn't. Somebody's missed out some invoices or what have you. But basically, it's trying to get the payment sort of gone through. So that's the point. Now you might be given a supplier statement and remittance advice, or you might be given a supplier statement and a purchase ledger figure. So you might, because this would be from the seller, the supplier statements from the seller, you would reconcile it up to the purchase ledger. So those are examples of questions, and you've got to find out what the differences are. Right, irrecoverable debts and age debtor analysis. One of the most important functions of a finance department is to ensure that customers pay their accounts. Customer may be successful, but it does not get paid by the suppliers it makes to customers, it's going to quickly go bankrupt. In order to consider how well the department is recovering its debts and to review which customers have outstanding debts, an age debtor analysis is prepared. This will separate debts periodically into amounts owed. So let's say amounts owed between 0 and 30 days, 30 and 60, or 31 and 60 days, 61 and 90 days, 91 to 180 days, and 180 days plus, something like that. Yeah. Through this analysis, a finance department can turn a debtors figure in the general ledger, so the trade receivables control account in the general ledger, into analysis of whether that debt is likely to be recoverable. So if something hasn't been paid in a year, it probably isn't going to get paid. So it's that kind of idea we can see. Now, what I'd note here is accounting software systems are often created by software developers, not accountants. So in real life, the segmentation that you might see in a digital system of the older debts into different periods is important. Developers often lump 90 days plus together, whereas in the real world there's a huge amount of difference between a debt that's 91 days old and a debt that's 365 days old. So you might have to sort of sometimes, or in real life, you tend to actually download it into Excel and then reanalyze it, or ask the developer to do their job properly. Now, doubtful and irrecoverable debts. If we know a certain customer is very unlikely to pay, so we actually know the specific customer who's very unlikely to pay, this is an irrecoverable debt. In this instance, the debt's written down to the amount that we recover, typically very little or zero, and the journal is credit the trade receivables control account, because the money's no longer coming in, because the money, so it's no longer coming in, the money in items going down, and so that's going to be money in the item going down as a credit figure. We would also make an adjustment in the sales ledger to that account, although we wouldn't want to sell to that customer again. But then going to go debit irrecoverable debt expense, because it's a money out item to shareholders that we're no longer going to have to give them. We've got less money available to them. We're not going to give that to the shareholders. So a reduction in money out item is a debit figure. So that's an expense to the shareholders. Plus, we may haven't. So that's our irrecoverable debts. So irrecoverable debts, we know who they are, and we will have that at level 2. Doubtful debts, you won't see that until level 3. Really, it's part of the extended trial balance question at level 3. But a doubtful debt is where we may have an idea that some customers will not pay the debts, but we don't know who they are. So, for example, we've got £1 million in total in the trade receivables control account, and over average 2% of debtors default, and we're probably going to provide about £20,000 worth against our doubtful debts. We don't know who they are, we just know that somebody's going to default.